So hello students, so welcome to this particular session. This session students would be in respect of a very important topic for the upcoming May 21 and November 21 attempt. We are students into this alternate tax regime. Students, the alternate tax regime has been introduced, few cases were being introduced with effect from assessment year 2021 and thereafter for assessment year 21-22 and onwards, certain new cases of alternate tax regime has been introduced. So earlier students, which you can see in the slide, so this particular alternate tax regime was there in the last AVA itself, which is the AVA assessment year 2021. But now with effect from 21-22, we also now have the alternate tax regime made applicable or made extended to a cooperative society, and also in the case of an individual in HUF. So therefore the scope has been expanding. The mandate of the government seems to be very clear that by giving this an option, presently it's an option, the government wants to do away with the extra incentives which is available under the Income Tax Act, which the SSC claims while computing the total income. Thereby he reduces the total income and eventually the tax liability. So these extra incentives which the SSC is claiming which generally in the form, like if I have to give an example, like we can say about like 35 AD capex deduction, additional depreciation, something like a profit link deduction, 10 AA. So these are some of the examples where you are allowed some extra benefit under the law, which enables you to substantially reduce your total income, and then on that total income you apply the normal rate of tax. So far as this alternate tax regime, the theme of these sections that we are going to go would be that we will give you an option whereby you can think of opting out of all these deductions that you are otherwise claiming. You forego these deductions, give up those deductions or the extra claims, and thereby compute a total income. And therefore, the total income so computed, which would be an enhanced amount, that total income, which would be, as I told you, an enhanced amount, on that total income, the tax liability would be charged. On that total income, students, the tax liability would be charged, and that rate at which the tax will be charged would be on a higher side. The rate at which the tax will be charged, students, would be on a higher side. Sorry, would be on the lower side. So that is exactly what this particular regime is all about. While we will proceed and discuss the provisions thoroughly, I'll also will guide you as to when the SSC will try to opt for these sections. One thing I can just tell you, students, that those SSC who do take these big deductions of like 35 AD or profit link deductions, which enables them to eliminate or substantially reduce their taxable income, I can just tell you that they will definitely not be tempted right now, presently at this stage, to opt for this particular regime, because if they have to opt for this regime, alternate tax regime, then they need to give up their particular deductions and all, which at this stage, knowing the fact that major of their taxable income is eliminated just because of application of these sections, so it may not be prudent on their part to opt for this alternate tax regime at this particular point of time. So those may be the cases where the option to exercise this particular alternate tax regime may not prove to be that feasible. Let's have a look primarily one by one. Students will look into it. So students, here right now I'm going to discuss, I'll just tell you the sequence. The first part, it would be all theory, wherein I'm going to discuss with you the alternate tax regime for a company, also for a cooperative society. We'll discuss the same, and in the second part we will then look into the practical part. The second and the third video would be about the practical part of this particular alternate tax regime for a company and the cooperative society. After that, we will look into our fourth video. On the fourth video, students, we will have the alternate tax regime as applicable to whom? To an individual. So, series of the 4 videos which will consolidate, conclude and freeze this topic. Again, I'm repeating. The first one, a theoretical part in respect of the company and the cooperative society. Second and third, the practical part for these company and cooperative society. And the fourth one would be a thorough discussion both on the theory as well as on the practical part of the alternate tax regime as is applicable to whom? To the individual and HUF. Okay, so on that basis, students, let's start with this. Students, now there is this 3 section which is applicable to a domestic company. 3 sections which is applicable to a domestic company. But I may say to all of you that this section 115BA, which you can see presently, this has more or less become redundant. By introduction of 115BAA, the second one, by introduction of 115BAA, the last one, which is 115BA, has been more or less become a redundant provision. How it has become a redundant provision also we will clarify in our discussion. Let's get started. Point number 1, applicability only to a domestic company, students. So therefore, for a foreign company, the alternate tax regime will not apply. Students, a doubt that may come in the mind is that whether this alternate tax regime will it be applicable to a non-resident. So students, whether this alternate tax regime will it be applicable to a non-resident? This is a doubt that may come into the mind. So students, the answer is, be careful, the alternate tax regime, students, the alternate tax regime is applicable in the case of a resident person, except in the case of individual and HUF, where they do have the option to opt for the alternate tax regime even if they are a non-resident. Even if what, students? Even if they are a non-resident. So the alternate tax regime would be made applicable to a non-resident only in the case of individual and HUF, whereas in all the other cases, which are the other cases? Namely, company, cooperative society, they are to be a resident only then they could opt for this particular provision. I'll give you those things in writing. I'll give those conclusions in the writing when I will do finally with you the individual and HUF taxation. At that point of time, I'll let you know, and we will conclude this particular part as well. Can you see the rate of tax, students? 15, 22 and 25. This is the base rate. Now, if you look into point number 3 and point number 3 for 115BAB and for 115BAA, can you see this particular part? What we have written in the bracket? Surcharge at the rate of 10%, students. Surcharge at the rate of 10% is always included in the case of 115BAB and in the case of 115BAA. Whereas if you see 115BA, if you can see 115BA, the surcharge factor is not included. Now students, before I proceed, this for those who would be viewing later on in the YouTube, the link would be given in the description box. So it will be there for the notes which I'm using it for these sessions. Okay, the link would be there in the description box for the notes part. Now students, over here if you see, the surcharge is always to be loaded when it comes to 115BAB or when it comes to 115BAA, and that happens in the case of these two scenarios. Now students, I can give you a mandate from where the surcharge gets loaded. So the surcharge gets loaded in these two cases through the Finance Act 2020, and in the Finance Act 2020 section 2 subsection 3. So if I refer section 2 subsection 3, there they have said that whatever is the rate, load it up with 10%, which therefore implies that irrespective of the total income, so even though the total income for that domestic company is say rupees 40 lakhs students, so even though the total income in respect of the domestic company happens to be rupees 40 lakhs, still what? Still the surcharge would be made applicable in respect of the SSE company opting for the option of 115BAB or 115BAA. But if you say that no sir, they have not opted for these two sections, 115BAB and 115BAA, then we all know that the surcharge applicability will arise only when your total income exceeds rupees 1 crore. Only at that particular point of time that the applicability of surcharge comes into play. So that is precisely how students you are supposed to look into it, and therefore if you are opting it, please don't consider this particular aspect that whether your total income has exceeded that limit or the threshold of rupees 1 crore or 10 crores. And be careful students, if you recall, for a domestic company whose total income exceeds rupees 1 crore and the total income when it exceeds rupees 10 crore, the rate of the surcharge differs. If I am talking about the normal tax liability computation, the rate of the surcharge will be different when the total income of the domestic company exceeds rupees 1 crore and the total income when it exceeds rupees 10 crores. Whereas over here, whenever you are in the alternate tax regime, first of all, there is no criteria as to how much should be your total income. The second is about the fact that the rate of the surcharge, irrespective of your total income, will always remain constant, and that is 10%. And hence, the effective rate that needs to be loaded would be 10%, and you will now get 17.16 as your final effective rate for 115BAB. For 115BAA, it would be 25.168%. That will finally be the effective rate after loading the surcharge. But you look into 115BA here, if applicable, so you know it goes as per what? That is, if the total income exceed 1 crore or 10 crore. Total income exceed 1 crore or 10 crore. This is a difference, fundamental difference. Okay, this is a fundamental difference in that case. You'll say, sir, then in that case 115BA is much better. Why much better? At least HEC would be there, no? HEC of 4% would be there, and if that is the case, then you can then just compare 115BAA, which is after including surcharge and HEC, the effective rate is 25.1. Whereas in 115BA, you think fine, surcharge is not there right now, at least in this year. But you at least have the suffering of 25% plus 4%, that is the loading. And effectively then, it is more or less in the same footing of 115BAA. And what will happen tomorrow would be whenever there is a total income which goes beyond 1 crore or 10 crores as the case may be, at that point of time this 115BA company will have the pinch. It will then get the pinch, isn't it? So that is the reason why primarily 115BA as an option is not going to be sustained. Yeah, agreed. You'll say then why 115BA was being introduced? That is a good question. So 115BA was being introduced, students, in the Finance Act 2017. So when FA 17 was introduced, at that point of time it was there, and at that stage only 115BA was there. So we never had this 115BAA and 115BAB. So that time the then Finance Minister, Mr. Arun Jaitley, late Mr. Arun Jaitley, he in fact has gone with this concept that we need to bring down the rate of tax. and India was following the US as well. We were looking very closely to United States, a development which was happening in US. And whereas in the US the tax rate came down to 25%, we also were following the suit. And then at that stage we introduced 115BA, and we also did it to 25. But then the US in fact drastically reduced their domestic tax rates to 15, and we also thought that it is now high time that we also should be giving these companies an alternate tax regime to enable them to reduce the rate to the extent of 15%. But that 15 would be applicable only in the first category, whereas in the other category, by introducing 115BAA being applicable to all the companies, they effectively have made the 115BA, which was originally introduced by Finance Act 2017, has been effectively made redundant. Point number 4. Now this point number 4, students, we have seen. Now what about the concessional rate of tax on the total income? Whether the concessional rate of tax on the total income, will that be applicable? Which is, sir, what is the concessional rate of tax, like long-term capital gains of 112A or short-term capital gains of 111A? Whether all these sections, will they be made applicable in the purpose of the computation? That becomes the issue under consideration. So the answer to that would be, if you speak about 115BAB or 115BA, 115BAA, the answer is yes, it will be applicable. So they have ensured that wherever the concessional rate is applicable, that continues to remain applicable. Those continues to remain applicable. So if a company has a long-term capital gains on the transfer of an equity shares on a recognized stock exchange on which STT has been paid, and the situation squarely falls under 112A, so both the computation as well as the tax rate would be as per 112A. However, may I say to all of you that in the context of the tax rate, which is 10%, the question then will again arise, what about the surcharge and the HEC? Say for example, the total income, and I am already opting for the this one, alternate tax scheme under 115BAB and 115BAA, and my total income is, say, even after computing the long-term capital gain under 112A, my total income is somewhere, say, around 40-50 lakhs. So therefore the question is whether on those income on which the tax is determined as per the special rate, whether we will be charging the surcharge. Will the surcharge be levied in those particular cases? That becomes the issue under consideration. To that the answer, students, is that yes, the surcharge in all the moment you are opting for 115BAB or for 115BAA, the moment, again I am repeating, the moment you are opting for 115BAA or 115BAB, the surcharge in all the cases will have to be loaded. So you opt for these provisions. And what happens? Any income which has been chargeable primarily, even if at a special rate, those income will have the loading of the surcharge and HEC as well. This is a very subtle point, students, and all these things are emanating, or they are all arising from what? From the Finance Act 2020. They are all arising from the Finance Act 2020, and that is the beauty of this particular part. So if we can just have a look quickly in this case, I'll just give you this particular point herein. So first of all, here what we have written, applicability of the concessional rate of tax on the total income of the company, can that be made applicable? To that the answer is yes, it could be made applicable. That is to say, the rate of tax is notwithstanding anything contained in Income Tax Act, but subject to what? Subject to the provision of Chapter 12 other than Section 115BA and BAA. Now if you see the things below that, rate of tax on the income covered under Chapter 12. So if you see over here in the bracket, for example, long-term capital gains chargeable to tax under 112 and 112A, short-term capital gains chargeable to tax under 111A. So such income would be subject to tax at the rate mentioned in the said section in Chapter 12. Surcharge at 10% would be levied on tax component in such income. HEC at 4% would be levied on the income tax plus surcharge. So you can just write here, therefore, please write. Therefore, surcharge at 10% shall apply in all the cases surcharge at 10% shall apply in all the cases applicable under section 115 BAB and section 115 BAA, whereas surcharge at applicable rate will apply only if the total income exceeds the threshold of rupees 1 crore or rupees 10 crores. Students, now all of you will read the next 2 points, and there is one bit of correction here. Please read this one carefully. For the PDF which I'll be uploading it in the YouTube later on. I'll do this particular correction which I'm doing it over here. So that is just in those who are referring the PDF file, which I'll upload it later on the YouTube primarily. For that file, this correction already would be there. Please read this one carefully, students, all of you. So students, now in this regard, let's look upon to this particular situation. So what it has been said about the rate of tax on the other income in respect of which no specific rate of tax is provided in chapter number 12. So students, for that there is no specific rate of tax in chapter number 12. I can just say to you that, for example, I'm just giving an example here in primarily. You can write here in example, say dividend income. Dividend income earned by the domestic company. Why I'm emphasizing domestic company? Because we are doing about domestic company, because foreign company, a non-resident earning a dividend income, students, a non-resident earning a dividend income or a foreign company earning a dividend income, what is there a special rate for that? Do we have a special rate if a non-resident or a foreign company is earning a dividend income? And the answer is yes. We do have a special rate under 115A, and the rate is 20%. The rate is 20%. In fact, that particular discussion we already had it in the taxation of dividend topic, which is from effect from assessment year 21-22. The new taxation regime for dividend taxation has been applied. So here, if you see very carefully, students, the dividend income which is earned by the domestic company, this dividend income primarily, if you see, it will be taxed at the normal rate. However, what they have said is that for this dividend income, there is this first proviso, students. This is this provision which you are finding is as per first proviso to section 115 BAB. As per first proviso to section 115 BAB. Now, if I go with the first proviso to 115 BAB, it becomes very obvious that this is what primarily would be my net effect. Now, what exactly it is, I think all of you have read it. So let us now discuss this particular part. Students, what happens in this? They say that for that particular income on which there is no special rate of tax, okay, and on which there is no special rate of tax, at the same time it is also not earned from the manufacturing activity. It is also not earned from the manufacturing activity, because 115 BAB as a section, students, pay attention on this one. 115 BAB as a section is applicable only to a manufacturer, which we will see, which is going to come anyway. So other than a manufacturing activity, if supposedly you are getting an income which is neither from that activity of manufacture nor it is incidental to the activity of manufacture, then those income you need to analyze very carefully. Those income you need to analyze very carefully, and you need to ask a question whether those income, do we have for those income any special rate of tax? Do we have for those income any special rate of tax? Is our question to be is the question to be asked in this regard. And if we don't have any special rate of tax for those income, again I'm repeating which kind of income I'm talking about it. The income which is neither from the manufacturing activity nor it is incidental to the manufacturing activity. So in respect of those income, students, the applicable tax rate that will apply would be what? Would be 25.168% flat again, irrespective of the total income. 25%, 25.168 flat. So you'll say, sir, but this is equal to that rate. Perfect. They have allowed that for this income, which is neither from the main activity of manufacture nor it is incidental. So that particular income will continue to qualify. Qualify for what? Qualify for this 25.168%. Okay. But there is a condition which you need to take a note of. And the condition is no deduction or allowance in respect of this thing would be allowed. No deduction whatsoever. So if we have to, and if supposing one example which I have given it over here is house property income. So house property income, if this company has, so it will fall under the head, which head? House property. Now under the head house property there is a standard deduction. Now what the law says, that first proviso you need to apply, and on that you will have to then take the entire income without any deduction at 25.168%. I'll give you one more example. Students, if a dividend income is earned by a domestic company, normal case. So those dividend income earned by the domestic company, students, we all are aware that without deducting the expenditure, that dividend income becomes assessable. Without deducting the dividend income, dividend expenditure, if you talk about normal provision, let's take first normal provision. If a domestic company is earning a dividend income, then in that particular case, because now the domestic company or an individual for that matter earning a dividend income, corresponding expenditure we have seen, like interest expenditure we have seen, there is a limit, but there is still a deduction available. We have seen those particular concept. So still the deduction is available. But then what happens over here to you? If you see over here in this context, the expenditure, students, the expenditure in this situation, will this be allowed to you as a deduction? The expenditure in this particular case, will this be allowed as deduction? And the answer is no. So if you are talking about 115BAB, that dividend income earned by a domestic company will not qualify for the purpose of any deduction. So therefore this particular point also merits our thought. It should always be borne in mind. Now one particular thing comes in the mind of the student, sir, is it like an optional, like we can choose between first proviso to 115EAB and see whether the dividend income, can we do it at the normal provision, or dividend income, can we do it in 115EAB? Can we have a choice between the two? Please pay attention then. If you are opting for 115BAB as a whole, okay, then within that 115BAB, then there is no choice that you can give for one particular part of an income. That kind of a choice is not available. So if the opt has been made for 115BAB as a whole, then individually for any income you don't have such kind of a choices. So even that is one point that you should also keep in mind. Thereafter, students, if you see what they have said, rate of tax on the short-term capital gains from transfer of a capital asset on which no depreciation is allowable under the Act. So In that particular case, students, short-term capital gains, we are talking about this one. So short-term capital gains from the transfer of a capital asset on which no depreciation, so non-depreciable asset in this case. So the applicable rate of tax is 25.168 plus surcharge plus HEC obviously. So that is 22 plus 10 and 4. There is, however, no restriction against claiming deduction or allowance. Means the normal computation of short-term capital gain. So it implies that normal STCG computation is done. Okay, just full stop. After that you can write this is not the STG which is chargeable under section 111. Why we have put across this observation? Because this 111 STCG goes above special rate. So this point number 4. So it goes in the special rate. Fine, students. By the way, if you see over here, the applicable tax rate is 25.168 for this particular part. Can you see that? The applicable tax rate is 25.168. There is, however, no restriction regarding claim of any deduction or allowance permissible under the relevant act. So, if you are assessing 115 BAB, the entire income is assessed at 25.168. Isn't it? The normal income of 115 BAB is at 25.168. So, there is no issues on that. So, and the way the deduction is allowed, subject to the restriction that we are going to see later on in the next particular thing. But apart from that, the deduction would be allowed normally, isn't it? Same is also with the case with 115 BA, because the rate was any case would be 25%, and accordingly for them also any deduction, if at all, would be there, you can take it. But if you are in 115 BAB, the fact that on that income which is neither coming from the manufacturing activity nor is incidental to the manufacturing, those income for which I have given you a couple of examples now, those income will qualify, will be subject to flat 25.168%, subject to the fact that no deduction of any expenditure will be given against such particular income. So this is a criteria or condition applicable only for 115 BAB. Just keep that particular point in mind. Okay, so that is one particular point which is something which you should be very careful about it. Fine, students? Fine. Now let's take the discussion further. So students, now let's look upon to our next particular part. Now this is all about the conditions to be fulfilled for availing the concessional rate of tax and the exemption from the MAT. So let's have a look. As I told you, students, 115 BA, this particular part is not that critical. 115 BA, students, per se, that is not that critical, but still we will look into that particular part wherever it is required. Okay, focus now on 115 BAB and 115 BAA, because as I told you, we will make this 115 BA redundant in one particular point. I'll let you know 115 BA is would be redundant. Already we have compared this earlier as well, and now I will establish that 115 BA is redundant. Let's have a look. The company should be set up and registered on or after 1st of October 2019. That is for this one, newly 115 BAB manufacturing case. Now, if you see for 115 BAA, there is no time limit specified, and therefore both the existing as well as the new companies can avail the benefit. Something, students, I will take you a comparative while I will do my last lecture of alternate tax regime. At that point of time, while I will do individual and HUF, At that stage, I'll do some connection. At that stage, I'll let you know. Point number 2, it should commencing the manufacturing or production. So upper time limit of manufacturing and production to be started should be 31st of March 2023. Now 115BAA, is it for manufacturing? It can be for anything. Manufacturing, non-manufacturing, all the domestic company could take the benefit of this section. 115BAA. Point number 3, students. It should not form by splitting up or reconstruction of a business already in existence. Students, this is where the real danger lies. People definitely will try to manipulate and will try to make an attempt. Make an attempt for what? They will try to make an attempt for the purpose of ensuring, because the rate is really very less, 15%, 15. And it is definitely will be catching the attention of all the manufacturer, majorly the existing one, who are paying the tax at say 30%. So suddenly everyone will get excited to rally behind this section, the manufacturing business. So those who have already have the business in existence, meaning thereby those companies or the business which may be before 1st of October 2019, what they may try to do then is that from their existing manufacturing setup, they will carve out and they will take a new factory. In that new factory or building, in that they will put across half of their facilities in that new building and will make a new company altogether. Will make a new company, and 50% of the customers they will shift it to that other company. 50% of the customers, students, they will shift it to that other company. If that is the way, students, they are going to do, that is the way that the things has to be done in that particular case, students. In that particular case, what then we are going to say? So we shall say that in all such particular cases, there is an attempt which has been made to split up the business which is already there in existence. To split up the business which is already there in existence, so as to take this particular concessional rate of 15%, and that will be considered as a disqualification. That will be considered as a disqualification. Students, if you can recall, this sort of a discussion I also had with you in 35 AD. In 35 AD section, we had the similar sort of a discussion that we had at that point of time. So here also the same sort of a discussion we are having it over here, whereby what we will say, we shall say that because of the split up of the business which is already there in existence, the company cannot take up the benefit of 115BAA. Now if you see point number 4 herein, this point number 4, now this, if you see for this one, there is no such condition which has been there. Why? Because as I told you, for 115BAA it is available for both the existing as well as for the new business. So I can switch over my existing business in the scheme of 115BAA, but I cannot switch over my existing business in 115BAB. That is the fundamental difference. I can switch over my existing scheme in 115BAA, but I cannot switch over the existing scheme in 115BAB. After this, it does not use any machinery or plant previously used for any purpose. Now students, if you remember, this condition is to supplement the above condition. To supplement the above condition, so as they are this is complementing the above one. So how do we keep a check on that? How do we keep a check that the above point number 3 abuse has not taken place? That point number 3 abuse has not taken place. One way to keep a check is that the business should not have been used in the form of what? In the form through a old plant and machinery. Through a old plant and machinery. So therefore, if a business has been used or has been set up through a new plant and machinery, then we can say that yes, in this business we can find what, that they have been initiated through a new business which has been for a new business that the SSE is going to initiate, the manufacturing business that the SSE is going to initiate. So in one way, point number 4 is supplementing the previous condition of point number 3. Okay. However, there is something that we will discuss towards the end. So therefore, there is a note that we will refer towards the end. But let's finish off the remaining part. It does not use any building previously used as a hotel or a convention center. So it is primarily meant for ITC and the Tata groups, specifically the ITC, because in their hotel building itself, they have got many hotel properties which they can use it for the purpose of, say for example, confectionery manufacturing. They can do it in some of their hotel units. Some of the facilities of their hotel units can be utilized for the purpose of manufacturing of the confectionery items, which ITC is into it. And that is the reason why they should not be, if they are using the hotel building, ensure that they are having primarily a separate factory building on which they are and engage on such particular facilities. They are engaged on such particular facilities. Point number 6. It should not be engaged in, this is very important point, friends. It should not be engaged in any business other than a business of manufacture or production of any article or thing, and research in relation to or distribution of such article or thing manufactured or produced by it. Now, A Limited, you can just write the example, students, started manufacturing on 1st November 2019 and opted for Section 115 BAB. On 1st June 2020, it also engaged itself in a warehousing business of agricultural produce along with the manufacturing operations. Full stop. Therefore, it has violated the conditions under Section 115 BAB it has violated the conditions under Section 115 BAB and accordingly the benefit under Section 115 BAB would no longer be available. And accordingly, the benefit under Section 115 BAB will no longer be available. Full stop. Now, students, here the catch point is this. All of you will pay attention. Here the catch point is that although the benefit of 115 BAB is no longer available, but can we say that the benefit under 115 BAA is that available? 115 BAA, can he switch to 115 BAA? Can he switch over to 115 BAA? And the answer is yes. In fact, in this section itself, you will find later on that it will say that if it violates these conditions, then obviously you will have to opt out from 115 BAB. But 115 BAA is all accommodating section. That is to say, it does not lay down which kind of the activity of business that the company or that the domestic company should engage into. So those level of criteria or the specification doesn't exist. And hence, if you have switched or if you have to forego 115 BAB because of the violation of the condition, you can definitely, students, go to Section 115 BAA. You can definitely go to Section 115 BAA. Students, keep this particular point in mind. Now, so I have dealt with this one now, students. Let's see point number 6. Common. Okay, just write that one sentence. However, please write. However, in such case, the SSE domestic company may opt for the provision of Section 115 BAA. 115 BAA. Are you all through with this, students? So now let's look upon to this common conditions for all the sections for availing the concessional rate of tax and exemption from MAT. So the total income should be computed, point number 1, without providing for deductions under any of the following provisions. So which are the provisions which will not have to be given up? The deduction under which provision that needs to be given up so as to compute the total income under these alternate tax regime applicable for the domestic company? Let's have a look to the list. 10AA, the deduction of profit and gains derived from export of article or things or from services by an SSE being an entrepreneur from his unit. 32(1)(2)A, additional depreciation is out. 32AC and 32AD, now students, forget it. Anyways, now it is no longer there with effect from AY 21-22. 33AB, remember the tea, coffee, rubber development allowance? So students, what will happen? Just remember that. In fact, we have discussed this particular point also earlier. So now what will happen would be that, see, earlier what used to be the situation was, on the deposit of the money to the NABARD, I used to get the deduction. So the deduction I used to get was on the deposit of the money where? In the NABARD. In the NABARD, students. Isn't it? Now what they are trying to say, students, over here in this context, what they are trying to say in this situation is that you have to give up the 33AB deduction, meaning thereby I can no longer take the deduction. I can no longer take the deduction as per the provision of section 33AB. As per the provision of section 33AB. That is what they are trying to now suggest in this case. Now, therefore, the underlying question is, if supposingly tomorrow from the deposit made in the NABARD, if there is a withdrawal that has taken place, from the deposit made in the NABARD, there is a withdrawal that has taken place, and the SSC and the SSC and the SSC and the SSC has incurred the expenditure from this particular amount that has been withdrawn, then whether the SSC who has say opted for 115BAB or 115BAA as the case may be, whether now he can claim the deduction on the basis of the actual incurrence of the expenditure from that money which has been deposited from the NABARD, and the answer is yes. And the answer is yes. So when he withdraw the money and incur the expenditure, he will be eligible to claim the deduction. He will be eligible to claim the deduction. But the 33AB scheme is out, because as per the scheme of 33AB, when you used to deposit the money in NABARD, at that point of time itself you used to get the deduction. So therefore, at the time when you were incurring the expenditure from the money so withdrawn, that was disallowed. Now this is not going to take place in this new regime. This is not going to take place, students, in the new regime. Did you all got this one? Fine, students? Let's have a look. So I think we have done with this particular part, 33AB. 33ABA site restoration fund also in the similar lines. Site restoration fund also on the similar lines. Now, if you see over here, students, 35, 1, 2, 1, 2, A and 1, 3. Just read this part. 35, 1, 2, 1, 2, A and 1, 3. So all the donations that you have given, students, all the donations that you have given to what? Given to all these companies or associations or the university or the research or the social science or statistical research. So in all these places, wherever you have given the donation now, students, what is that we are going to say? That these donations, students, these donations will be what? Will you be getting an allowance of the same? Now with this, you will get disallowed under these sections. But can I say, now is it disallowed forever? Is it disallowed forever? And the answer is no. Why it is not disallowed forever? Because, students, be careful here. There is 80 GGA as per which the 100% deduction is available. 100% deduction is available. In 80 GGA, students, 100% deduction will be available. So even though it is getting disallowed from the head PGBP, even though it has been disallowed under the PGBP, still what? Still this deduction is allowed to you in section 80 GGA. In section 80 GGA. That is chapter 6A. In this regard. So now in this context, if you all have been through with this particular point, all of you through with this? So 100% reduction is available. Now if you see 35 2AA students, now just that weighted is removed. Now deduction at 100% of the payment is allowed. Fine. So even though it is getting disallowed under that PGBP, the net effect remains the same because anyway it will be allowed to you under 80 GGA. Now if you talk about this 35 2AB, wherein you used to get again a weighted deduction earlier, now it is 100% with effect from your AY 21-22. So I'm just deleted that in that PDF which would be given in the YouTube, so that I'll just do the correction. So deduction at 100% of in-house research, scientific research expenditure incurred by a company engaged in the business of biotech. So students, you tell me in this case, remember what used to happen? The capital expenditure that you were incurring, you will getting the deduction like plant, building. So you will getting a deduction if you are under the normal scheme of 35 2AB. Under the normal scheme of 35 2AB, then you are eligible for taking the deduction even of the capex. Also, the revenue expenditure was allowed in the 35 2AB. But now, if I want to go with 115BAB or 115BAA, whatever section, then I need to opt out from the scheme of 35 2AB. Now you have to think like this, students, that if you are opting out from 35 2AB, what is that alternate option that is going to happen? If you are opting for 115BAB, then what is the treatment that you now need to take into account? So students, the treatment that you will now need to take into account would be, so in 115BAB, what will happen? The capex in this situation will qualify for depreciation. The capital expenditure that otherwise in the normal scheme, if you go, you get a full deduction of the capex, and here you will get in the form of depreciation. And second, students, the revenue expenditure, can we say that would be allowed as deduction, students? Would be allowed because it's a scientific research, so would be allowed under section 37(1) anyways. Why? Because this research expenditure would be considered to be an expenditure for the purpose of business. For the purpose of business. Isn't it? So therefore the revenue expenditure which has been there, that anyways could be allowed under section 37(1). So there is no harm in that. We will be doing some comprehensive questions, students. In the next segment, I'll be doing with you a comprehensive question on this practical part of it. So just let's hang in for it. First, let's complete the theoretical part. So it will be allowed under 37(1) anyways. 35 AC, you can just skip this one. 35 AD, investment link deduction, students, your popular section. So if the company wants to opt for 115BAB, BAA, in that case they will have to opt out for the 35 AD deduction. You will not consider 35 AD, and if you cannot consider 35 AD in that particular case, herein, in that particular case, what will happen over here? You will claim a deduction of depreciation. So I think that is a logical recourse under 115BAB or BAA. If I am going with this alternate tax regime, then I will no longer be allowed to take a full deduction of the capex, but I will have to come with the conventional route of claiming the depreciation allowance. 35 triple C and CCD, students. Can you see that the deduction at 100% of the expenditure incurred on the notified agricultural extension project? Again, the next particular part, students, weighted average deduction at 100% of expenditure incurred by the company on notified skill development project. Now, even in respect of these items, students, even in respect of these items, you can find what? That herein the capex, if you have incurred, so depreciation would be allowed over here, and second, a revenue expenditure would be allowed under 37(1) if what? If it is for the purpose of business and profession. There is one question that I am going to do, wherein in that question I have assumed that it is for the purpose of business and profession, because that was a sugar manufacturing company. In this next segment, students, there is one question on sugar manufacturing company which we will discuss in the next segment, and there this we have to assume that this expenditure, primary, whatever is the revenue expenditure, if at all there is a revenue expenditure that they have given to you, then that is assumed to be for the purpose of business and profession, and therefore it would be allowed as deduction. Because obviously it becomes a bit, unlike in the case of scientific research, it can be related that okay, it is meant for the business of the SSC, but agricultural and the skill development becomes a bit tricky, whether we should consider it for the purpose of business and therefore we could allow it as a deduction to 37(1), or it is otherwise. Like, no, we cannot say that it is for the purpose of business. It has got no connection with the business, and therefore it may not be even covered under 37(1). Then it may not be even covered under 37(1). So therefore, this is one of the trickiest part which we have to take into account. And in fact, this question I can just share with you. Question number 2. Anustup Chandra Limited. I'm just giving the reference. Refer. Apart from that, students, now, so I've discussed it over there. Anustup Chandra's question. Anustup Chandra's limited question. Now, profit link deduction, students. ATIA to ATRRB. Students, ATIA to ATRRB, that is out from the game. What about ATGGA? Just now I told you ATGGA is allowed. ATGGA and ATG, those are something that the company can take the deduction. In fact, this is such an important thing. Why? Because students, if you see now the cooperative society, which is going to come up next, and for an individual alternate tax regime, there you will find that the entire chapter 6A is eliminated. Entire chapter 6A, students, is eliminated. That is what you are going to find it over there. We shall consider it and I'll let you know. So that is also one of the point. Thereafter, students, then, so there, however, students, they have shown the mercy, and they have allowed to you this 2 section, the deduction for the 2 section, which is that ATJJ and ATM. So they have shown their mercy, and accordingly they have given you the deduction in respect of these sections. Fine. After this, students, point number 2, if you see, without the set-off of any loss carry forward from any earlier assessment year, if such loss is attributable to any of the deduction listed in one above. So what does it imply? that much portion of, students, that much portion of the loss or the UAD which is attributable to what? Attributable to the deduction, above deductions, or the additional depreciation, because for UAD what is prohibited is the additional depreciation under this alternate tax regime. So that much of the portion of the loss and that much portion of the UAD will get lapsed. This I will take you through to in my third lecture of this alternate tax regime. In that, there is one practical question on the corporate society with a similar condition. At that stage, primarily, there is one case study which we will go through it in the third class. This is the first one, then the second and third. Point number 3, by claiming depreciation 32, determine in the prescribed manner. Fine, so that we can do it. But additional depreciation you cannot take. Now, students, there is this note of 115BAA. I just want you to all go through it. Later on, please go through it. Ensure to just go through this particular note. Fine, 115BAA. Because you have just done this IFSC also. Just now we have done this IFSC also. Also, you have done with the practical question on that IFSC, International Financial Service Center. So, students, just go through this particular note once. And that should be all. Please come to this point. You don't have to write this left hand side. I have already made you write. Students, let's see. Failure to satisfy the condition. On failure to satisfy the condition mentioned in point number 5 and 6. You will say, sir, what is point number 5 and 6? See, this is the point number 5. And I can have given you one example. Point number 5 is this one. And point number 6 is this one. Okay. So, point number 5 and point number 6. So, what they have said? On failure to satisfy the condition mentioned in point number 5 and 6 above in any previous year, the option exercised would be invalid in respect of the assessment year relevant to that previous year and subsequent AYs. Consequently, the other provisions of the Act would apply to the person as if, students, the other provisions of the Act would apply to the persons as if the option had not been exercised for AY relevant to that previous year and subsequent AYs. So, consequently, the other provisions of the Act would apply to the person as if the option had not been exercised for the assessment year relevant to that previous year or the subsequent AYs. So, what does it imply, students? So, the option exercise would be invalid in respect of this thing and subsequent AYs. So, it means that now you cannot come to 115 BAB. But consequently, the other provision of the Act would apply and the person as if that he has. So, it means normal provision will apply. But see the note. What is the note? Where option exercised under 115 BAB is rendered invalid due to the violation of conditions stipulated in point number 5, 4 to 6 above, such person may exercise option under section 115 BAA. Can you see that? And that is the reason why that warehousing business example I have given it to you. In that, the same particular thing, the warehousing business I have started also in the next year. So whether I can opt for 115 BAA, and the answer is yes. And so far as 115 BAA is concerned, point number 5 was not there at all. Students, point number 5 was not there for 115 BAA. Okay, because the focus of point number 5 was only about the manufacturing part. And the point number 6 was all about, what was point number 6 focus? So the focus of point number 4 was on the manufacturing part. The focus on point number 6 is on what? Not on the manufacturing part, but the focus on point number 6 is in respect of, students, is in respect of what? Perfect. So the focus of point number 6, students, is in respect of which are the sections on which you will not take the deduction. So the deduction will not be available in respect of which sections? That is what point number 6 is all about. So supposingly you have taken the deduction under those restricted or prohibited sections while you have opted for 115BAA. In that particular case, you are violating this 115BAA, and therefore what? You will now have to opt out from this particular scheme, and you cannot re-enter thereafter. You cannot then re-enter thereafter. So that is the consequence that will be felt in this sort of a violation that you will do. Can you see, students, here in MAT is not applicable. So this is again a big breakthrough which the government has done in terms of non-applicability of the MAT, students. In terms of the non-applicability of the MAT. So that is again a big breakthrough on the part of the government. Point number 9, availability of set-off of MAT credit brought forward from the earlier years. Now, students, obviously the MAT credit will get lapsed, isn't it? Now, this partner here, if you see, for this is a new company, and there would not be any concept of the brought forward MAT credit, because it is a new company, and you will realize that in the first year of filing of the return of income of this new company, they need to take an option. In the very first year of the filing of the ROI, they need to take the option whether I should go for the normal provision or I should go for 115BAB. And whichever option that they may have taken, that option will be there with them throughout. That is one. Secondly, but yeah, they can definitely later on, if they want, they can go to 115BAA. That is a possibility. But 115BAB, you need to opt freeze in the very first return filing year itself. What about for 115BAA? Again, students, all the MAT credits and all, students, because obviously when you are in 115BAA now, you want to opt for 115BAA, there is no MAT at all. So when there is no MAT, but till the last year, because you were paying the tax as per the normal provision, and the tax as per the normal provision used to get compared with the MAT, and therefore the MAT credit got generated. Accordingly what? Accordingly, there could be a MAT credit. Accordingly, there could be a MAT credit up till last year. Now, here if you see very carefully, as far as this point number 9 is concerned, here if you see very carefully as far as point number 9 is concerned, what they are saying is this, that the brought forward MAT credit cannot be set off against the income under 115BAA. Obviously, because this is an alternate tax regime when you don't have any MAT concept. And if you don't have now any MAT concept, the question of the MAT credit getting adjusted against what? Against this particular 115BAA income will not arise. In fact, what is being suggested to all the SSC is this, that you should exhaust your MAT credit first in the normal scheme, and then you should enter 115BAA. You should exhaust first all these one MAT credit or all the UADs and the brought forward business laws, which has a big impact, because of the big sections, which will no longer be allowed in the new regime. So that is what is advised to all the clients and the SSC, that you should exhaust first all these and then to enter into this new regime, so that there is no pressure on these particular category of 115, that about lapse and all these things. This pressure is no longer there. So brought forward MAT credit cannot be set off against the income under 115BAA. Okay, so there, see the note. If a company has a brought forward MAT credit, it can first exhaust the MAT credit and thereafter opt for the section 115BAA, because there is no necessity that the very first year of this you need to opt for 115BAA. It can be opted by anyone. Later on also you can opt. Point number 10, students. Adjustment for the transaction with the person having close connection. Obviously now you can try to manipulate this, knowing the fact that it is subject to a 17% rate. There can easily be some sort of a manipulation that can be done. Students, that can be done. And accordingly, students, in such particular case, the assessing officer has been given the power under 115BAB itself to rework their profit if the transaction with a person with whom the SSC domestic company is having a close connection, that transaction is not as per the arm's length price. So therefore, he will rework the profit and be mindful of the fact the profit that he will now compute. Be careful. Don't expect that profit will be subject to a tax at the rate of 17%. Now that profit, students, the chargeability, see the rate for yourself. The chargeability would be at what rate? 34.32. So the profit which the AO will compute. Because with the close associates, the person with whom you have got a close connection, you have entered into a transaction wherein the profit is not as per the arm's length price or at the fair market value, then the profit that is so computed by the assessing officer, don't expect that on that enhanced profit computed by the AO in this transaction with the person with whom you are having a close connection, you don't expect that on these transactions now the rate that would be applicable would be what? 17.1. It would be at 34.32 flat rate. Surcharge at 10% would be at flat. Students, I want you to read point number 11 carefully. All of you, read this one peacefully. This analysis, I'm going to do it in my third video, in my fourth video, alternate tax regime, when I will do with individual and HUF. At that time, we will make one table also. But right now, you will just at least go through it quickly. All of you go through this one carefully. Very important part. All of you through with this one? So students, so that is the first of the return which I have highlighted. Just also ensure to highlight in the same way. And can you see this 115BA, the last highlight? What is this particular thing, 115BA? This is the very reason why I said that it is redundant now. Because after surcharge, the rate of 115BAA is 25.1. Whereas without surcharge is only 25%. Plus, at least forget the surcharge, but HEC 4% if you load, then it will be escalating, isn't it? So the company once exercised the option for any previous year, then it cannot be withdrawn for the same year. Further, where the person exercised the option under 115BAA, the option under 115BA may be withdrawn. So if I want to go for 115BAA, being an existing company, then 115BA option, now that can be withdrawn. So you can withdraw 115BA for opting for 115BAA, not for what? Not for the 115, not for the normal provision. So you cannot go to the normal provision by opting out 115BA if at all you have taken 115BA earlier. Now students, just have a look to that condition. Remember that the plant should not be used, the old plant and machinery should not be used for the purpose of this 115BAB business. Question therefore is, do we have any exception that I can use some old plant and machinery? Why I'm emphasizing on this? Because if you can remember, we have done some comparison. Additional depreciation, if you see students 3212A, there is a strict no for additional depreciation. That is, if you want to take an additional depreciation, then with what? If you want to take the additional depreciation, then with the old plant and machinery, either domestic or imported, you cannot start. You cannot take the additional depreciation. So therefore, no additional depreciation is available if you are acquiring an old plant and machinery, whether imported or domestic, doesn't matter. But if you see, students, if you see the provision of which provision? If you see the provision of 35 AD, there I have told you that look, for imported plant and machinery, there is a relaxation. For imported plant and machinery, students, we had the relaxation, if you remember that. But for the domestic plant and machinery, students, there we had what? Students, for the domestic plant and machinery, there we can say we had this particular proposition. For the domestic plant and machinery, students, we had this particular proposition of what? For the domestic plant and machinery, up to a limit of 20%. If you can recall, up to the limit of 20% of the total value of the plant and machinery, that was considered as eligible. But beyond 20% of the domestic old plant and machinery, if you use to set up the business of 35 AD, then disqualified. So what is the condition over here? That is it that no old plant and machinery is allowed for 115BAB business, or some relaxation has been given to us? Please let's have a look. So note has been given in relation to point number 54 in column number 3 of the above table. Any machinery or plant which was used outside India by any other person shall not be regarded as machinery or plant previously used. Machinery or plant previously used for any purpose, if all the following conditions are fulfilled. Students, if all the following conditions are fulfilled. And which is that following condition which has been fulfilled? So please underline this one, outside India. So shall not be regarded. So it implies that similar to 35 AD. Can you see this one? A, B and C. So I have written here also condition similar to that of section 35 AD. So same thing for old plant and machinery, which is an imported plant and machinery. Therefore, such machinery or plant was not at any time before the date of installation by the person used in India. Same condition of 35 AD. Such machinery or plant is imported into India from any other country. So that is about only the imported plant. And the next one is about, also please highlight, circle this word all. In this also circle this word all. The next point number C is deduction not granted on account of depreciation in respect of such machinery or plant has been permitted or is permissible under the provisions of Income Tax Act 1961 in computing the total income of any person for any period before to the date of installation of the machinery or plant by the person. So in that regard, students, if you see very carefully, What is that we are going to say? So it means here in eligibility of imported used plant and machinery. Imported but students. Additional depreciation under 32(1)(2)(a). 32(1)(2)(a) ineligible. 35(a)(d) eligible. 115(b)(a)(b) eligible. Please copy it on this one quickly. So what is that situation which has been there over here? The same thing, students. Can you see this? 20%. Domestic for a domestic. Use domestic plant and machinery threshold percentage. Same as that of 35(a)(d). So the 20%, up to 20% of the domestic plant and machinery can be used. Up to 20% of the domestic plant and machinery can be used for the purpose of this 115BAB business. But if it goes beyond 20%, then the way we have discussed for 35(a)(d) that it will be disqualified, same thing will happen over here also. Meaning thereby you cannot then take the benefit of 115BAB business. Now, so this is important. This is a very important thing. The business of manufacture or production of any article or thing shall not include what? Business of development of computer software in any form of media, mining, conversion of marble blocks or similar items into slabs, bottling of gas into cylinders, printing of books or production of cinema films. So why I have underlined printing of the books? Because so supposingly Bharat Law House Private Limited. So it's a Bharat Law House Private Limited. Now if they want to opt for 115BAB, although I must say to you that the printing of the books per se is a manufacturing activity, which for them they may get an additional depreciation as per the normal provision of the income tax law. They may get an additional depreciation under the normal provision, but if they have to opt for 115BAB, for that the manufacturing activity will exclude the following manufacturing activity. So the manufacturing activity under 115BAB will exclude the following manufacturing activity. So although on the new plant and machinery which Bharat Law House may have purchased, for them they will be eligible to claim the additional depreciation in the normal provision, but the same Bharat Law House Private Limited being in a printing business, this is not an eligible manufacturing business for which the alternate tax regime is available. This is not the business for which alternate tax regime is available, meaning thereby they cannot avail 115BAB. Some students will say, sir, but can they avail 115BAA? Why not? 115BAA is available for any domestic company. And it is not that it is only for manufacturing. But if you want for 115BAB, the manufacturing business of 115BAB will exclude the following manufacturing activity. So just be very careful about this particular part as well, students. And this, please take a note of this one. That 115BAB, the note on this one, the manufacturing note. The above exclusions exclusion is specific only for section 115BAB only for section 115 BAB. Therefore, where the SSE is engaged Therefore, where the SSE is engaged in the printing of books, then the same would not be considered as manufacturing. Then the same would not be considered as manufacturing for the purpose of section 115 BAB. For the purpose of section 115 BAB. Full stop. However, such SSE can claim the additional depreciation as it is considered as a manufacturing activity in the normal course of business. In the normal course of business. Fine, students. So this is how the things has to be looked upon herein, and that is it primarily. Now with this, now students, the last segment, quickly we will do the cooperative society also. It's a small particular area, so not much to be deliberated, and then in the next video onwards we will start with the practicals. Let's then begin with this cooperative society, students. Students, let's first discuss the normal provision, and then we go to the alternate tax regime. Alternate tax regime is a similar, primarily there is not much of now newness, but here and there bit difference is there, and that should be all. As far as the cooperative society, students, is concerned, their normal provision, if you see whatever is the total income that they will determine, there is one big deduction of 80p for the cooperative society. So on that big deduction of 80p for the cooperative society, they will determine finally their total income, and on the total income, the tax rate which is applicable to them, the general tax rate, is on the slab rate basis. They also have the slab rate. That is quite surprising. And the slab rate is 10, 20 and 30. Up to 10,000, there is no exemption limit, but up to 10,000 it is 10%. Between 10 to 20 it is 20, and about 30 it is 30%. If the total income exceeds by more than rupees 1 crore, then they have a surcharge of 12%, and HEC, as we all know, is 4%. So this is their normal tax structure. Obviously, if you can say that, sir, what if that they have got some special income? So if they have a special income in this total income, will that special income, will it be charged at a special rate of tax? To that the answer is yes. So that same thing will be made applicable. Now for them also alternate tax regime has been introduced. So if you see over here now, but before that we'll just go with this ATP, because that is one of the main deduction. In fact, students, I'll tell you one thing. If ATP deduction is not substantial, students, if ATP deduction is not substantial, or for a cooperative society ATP deduction is not available, for a cooperative society ATP is not available, in that particular case what? Then going to alternate tax regime would be much lucrative as compared to the existing tax structure. But obviously you have to do a comparison. There is no hard and fast rule. You need to do the comparison and then finally see which is much better between the two. But I'm just giving a general remark in this context. A general remark is that if there is no substantial ATP deduction, or there is no ATP deduction available to a cooperative society, then maybe chances are very high that going with the alternate tax regime would be much better in terms of the tax liability as compared to this. So what is the one which will come in the difference between opting or not opting is this ATP deduction. Students, there is a 100% deduction from the primary activities. Can you see this one? There is primary activities and the next one is the investment activity. So the primary activities, they will have a 100% deduction. You will say, sir, what are those primary activities? Just quickly go through this primary activity, students. Quickly go through this primary activities. Read it once. Quickly. Fine, students. Now if you see herein, income of the banking business for its member. So what I have written is that other than the cooperative bank of 3617A, this is what I have written. On the red that you are wondering what has been written is written as other than the cooperative bank of 3617A. Cooperative bank, students, they don't get ATP deduction. They get 3617A deduction in respect of the provision for the bad and doubtful debts. So here if you see in this context, this ATP2 primarily which has been there, just write it down other than the cooperative bank of section 3617A. Please have a note of this. Through this, students. So now in this regard, if you see very carefully, what is the situation? These are the main income primarily which has been exempt. Now these main income students also include like some, if you can see this agricultural income which has been there. So this is the agricultural income, this is the fishing and the milk. So I'm just telling you about these particular, the main activity, that is agricultural could be the activity, but be careful students here. The processing should be without the aid of the power. Here also one of the point which has been there, it should be without the aid of the power. So all these particular activities combinedly, all these activities of the corporate society for the benefit of their member will fetch them 100% deduction. And this is where the corporate society may go on the back foot and may not like the alternate tax regime, knowing that it is getting a full deduction of ATP on these main income. If there is an income from the other activities, like there can be other corporate society, can you see this ATP2C? What is this ATP2C? These are the two bullet points which are being there. One is in case of the consumer cooperative society like Apna Bazaar, that is a consumer cooperative society. So for them they get, because they obviously for them the first activity is not there. This is not the activity that Apna Bazaar engages themselves. So for them 1 lakh is the flat deduction that they are going to get. What about cooperative housing society? Cooperative housing society, whether cooperative housing society, will they get this 100% reduction over here? All these activity, can we say it will be falling into this category? And the answer is no. So cooperative housing society students, again they will go under this category, and they will get 100% reduction in respect of these income. 100% reduction in respect of these income. So that is for the cooperative housing society. Sorry, they will get 50,000 flat deduction. So the example you can write over here. Example for this one is that cooperative housing society. On our third lecture of this alternate tax regime, we will deal with this particular part. I'll just have a practical question on this one. Apart from that, students, income from investment income, income from the investment income. So ATP2D, 100% of the interest and dividend derived by a cooperative society from its investment in any other cooperative society is deductible under section ATP2D. So if one cooperative society is making the investment in the shares or giving a loan from which they are getting dividend or interest, then that will be eligible for a full deduction of 100%. And if the cooperative society has has done the let out of their godown or warehouse for storage purpose, then again in respect of that income they will get a 100% full deduction. Let's see this question today. Mysore Cooperative Society derives income during the financial year 2021 from the following sources. First is income from processing with the aid of power. Aid of power. Will it qualify for 100%? No. Income from collective disposal of the labor? Yes, it will be. Interest from the another cooperative society? Again, 100%. Income from the house property computed? No. It will not qualify for ATP. Income from other business? Again, the answer is no. So this, any case, will have a flat 50,000 deduction, students. This other business will have a flat 50,000 deduction. Income by way of dividend from another corporate society, again this dividend income also will have a full ATP deduction. So if you see over here, house property income, PGBP, processing with aid of power 40, collective disposal 20, from other business 72, 132 in all. IFOS, interest received from other corporate society 12, dividend from another corporate society 15, 27,000 is what I am getting. GTI 234, less ATP deduction, students, ATP. So ATP interest and dividend 12 plus 15, 27. Income from collective disposal of labor, fully deductible under ATP, assuming that stipulated condition of 20,000. So this is 20,000. Income from other business, students, other business 72,000 minus the deduction is 50,000. So the deduction maximum is 50,000. That is what we have seen. The maximum deduction is 50,000. So that maximum deduction is what would be given, and that is what it is. So it is a simple question, which just a reproduction of what we have learnt about. Students, now let's see the alternate tax regime, BAD, bad. So BAD is for corporate society. BAB, BAB, domestic company manufacturing. BAA, BA, again domestic company. Then for, you'll say, what about individual and HUF? BAC, back. So BAC, back, is for individual and HUF. So that is how you can remember the section number. BAD, BAB, BA and back. So that is precisely how you put it across. So let's see. Notwithstanding anything contained in this act, but subject to the other provision of this chapter, the income tax payable in respect of the total income of a person being a cooperative society resident in India. So underline the word resident, students. For any previous year relevant to the AY, beginning for, so this is with effect from AY. Which AY? AY 21-22. Shall at the option of such person be computed at the rate of 22%, but students, there would be a flat 10% surcharge plus 4% HEC. So 22 plus 10 plus 4, the same thing. What we have discussed for 115 BAA, same rate it will eventually turn out to be. Condition and restriction under 115 BAD. Exemption and deduction under, this salary is written, students, just delete this salary and write PGBP. Exemption and deduction under the head PGBP. So all the same, remember students, the same thing is there, all what we discussed in just concluded 115 BAA. However students, can you see point number 6? What did I told you in that particular? I told you already that as far as 115 BAA, BAB is concerned, only the profit link deduction is out from the game, but at least you get ATG, ATGGA. But when it comes to cooperative society and the next part of individual that you are going to see, you don't get any chapter 6A except for ATJJ, AA. So deduction under 80 to 80U gone out from the game. Even that resident you will find individual, even the individual and HUF that we are going to see later in our 4th lecture of this series. So there also you will find the same thing. But that is one of the big prize. I'll give more explanation at that point of time. But just keep in mind this. Rest of it, whatever conclusion that we have done, that's the reason why I have written same as that of 115 BAB and BAA. So you don't have to worry much on that. Now, adjustment of loss. What they have said, the total income of a resident cooperative society is calculated without adjusting the brought forward and or additional depreciation from any earlier year. Just write after the students, after earlier year, please write in the PDF file, it will be there, but just now all of you can write earlier year attributable on account of the specified tax incentive provision. Attributable on account of the specified tax incentive provision. So if you have got a brought forward loss or the UAD because of these specified tax incentive provision, which are those specified tax incentive provision? The arrow is touching that box, all that particular tax incentive provision. So that much of the loss or the UAD definitely, which we want to make it lapsed. The UAD students that we want to make it lapsed, that UAD students is about what? Additional depreciation. Perfect. That UAD is about additional depreciation. Now here students, they have the AMT. Cooperative society students, we all know they will have the AMT concept. So whether this particular, the MAT credit, any case we have discussed for 115 BAA, here we will have to discuss about the AMT. So what is that we will say? AMT will not apply to a resident cooperative society if it opts for the alternate tax regime under 115 BAD. Further, AMT tax credit of earlier year cannot be adjusted against the tax liability which is computed under section 115 BAD. So that is all about the applicability so far as the AMT is concerned. So I think the same thing what we discussed earlier is what will be considered over here. Students, read the last paragraph, last box. So we will have the prescribed manner, means the rules are yet to be notified. So we will see whenever this rule gets notified that time. The option, students, has to be exercised. Again, this thing at the time of filing of the return of income. Again, here there is no first AY. Just the way we have got for 115 BAB, this is also not the case for the cooperative society, which therefore implies that even later on, I can opt for 115 BAD. Okay, so that is one thing which has been there. But once you opted for 115 BAD, subsequently you cannot withdraw from this option. So students, we will see this comprehensive questions which are being there. Comprehensive question on the company, alternate tax regime for the company. We'll do that. We'll solve some very good questions. Then the third part would be for corporate society, third video on this alternate tax regime. The fourth video would be for the alternate tax regime for individual and HUF. So that would be the closure so far as the alternate tax regime is concerned. See you then, students, now with the practical problems in the next video.